Welcome back. You're still tuned into Halftime Report. It's time to focus on the affordable housing segment. The sales in the segment have been declining. The affordable housing launches have also declined in 2025. To understand what the industry is doing, how they're navigating the challenges, and what the real ground reality is, we are joined by Prashant Thakur, ED and Head Research and Advisory at Anirog. We also have with us Kartik, Senior VP and Co-Group Head Financial Sector Ratings at ICRA, to understand the lender's perspective as well. Gentlemen, good afternoon. Thank you so much for joining us. Prashant, let me start with you first up to understand what the ground reality is looking like. The conversations that we've had indicated that affordable housing is going through one of its worst phases when it comes to sales and launches. Can you give us a sense in terms of numbers? How has the performance been? And is it a builder-led problem or a buyer-led problem?
It's no doubt that last 3 years we have seen a phenomenal growth in overall residential real estate, but it came at a cost of affordable housing. We saw a K-shaped recovery where upper segment really did well, and affordable, which accounted for almost 45% in 2019. By the end of 2025, its share was hardly 13 to 14%. So that's the sad story that has played out, unfortunately. And it's kind of more of a structural problem that I would say. The definition of affordable housing is kind of quite outdated in terms of today's context. And affordable housing has a very limited capability to absorb shock. And what we have seen during these disruption, which was caused by the war and various other disruption in terms of tariff, the ability to absorb cost was quite limited for this sector. And also after pandemic, what we have seen is that the preference for larger houses was quite significant, and that's where the developers focused on coming up with the launches. And a couple of factors which includes steep land prices that the developers acquired land at, the increase in construction cost, and also in the demand side, if you notice, the buyers of affordable segment comes from I would say unorganized sector. So for them, credit availability in this scenario becomes a challenge. So I would rather say, in spite of overall sector doing quite well, affordable has lagged because of structural challenges, and its ability to absorb shock is very limited.
Okay, structural challenges, and the segment is unable to absorb challenges and shocks that we're seeing. Mr. Kartik, let me come to you because your report says that there is moderation, but there's been decent growth. So it really doesn't match the commentary that you are giving and what Prashant is saying. Can you explain what your report suggests? You're seeing green shoots. Is it in projects which does not match the definition, because that also is outdated? Give us more sense of what you are seeing on ground.
Sure, good afternoon. From an affordable housing entity perspective, right? So we are looking from our financials. They specifically focus on tier 2, tier 3 locations and so on. So the data that we see in general from a real estate point of view does not get into so much granularity. So from an affordable housing financial perspective, about 50 to 80% of their exposure is towards semi-urban and rural locations, right? Depending on the entity that we see, and a sizable portion of the funding, especially from an affordable housing entity perspective, about 40% of their funding goes towards self-construction. When I mean self-construction, is the borrower constructs his own house. He has a land, he just borrows and constructs the house. All of this does not get captured in the broader scheme of data which comes out from a housing sales perspective, which is more organized, if I have to put it, from a market perspective. So this is where the divergence comes in. We expect this segment to grow at about 20%, while you see the organized part of this business, which is somewhat primer kind of a product, you will see a much slower growth of about 12-13%. So the divergence is essentially the nature of product that is getting financed in the target borrower segment, which the financials target vis-a-vis what is available at a headline, sales data level.
Kartik, I just want to understand, right? Are banks actually becoming more cautious also on the lending towards lower income borrowers? How is that also? If you could help us understand that also.
Banks have a larger play in the prime segment, which is 25-30 lakh average ticket size, and we have a clutch of housing finance companies which do operate in this space. When I say affordable housing entities, these are entities who have an average ticket size of about 10-15 lakhs, right? So this forms about close to about 15-18% of the total housing finance company market. When I say housing finance company, it's only the non-banks. In the broader scheme of the housing market, which is close to about 45 lakh crores, the affordable housing finance accounts for only about 1.5 lakh crores. So it's a very small segment at this point in time in how we define affordable housing, and the growth on this very small base has been quite high and then quite healthy, about 20-odd%.
Prashant, you spoke about it, that how affordable housing, the definition is quite outdated as well, and we understand that industry also wants affordable housing, that cap to be raised also. Your thoughts on that, and what will it mean also in terms of EBITDA margins? Are there normally affordable housing has thinner margins versus premium?
To answer the first part of your question, yes, the definition needs a reset. Today, affordable housing, as per the definition, is still capped at 45 lakhs and below. And this definition was set, I think, almost 6-7 years back. And after that, we have seen a huge run up in the cost, and then it doesn't make sense to get stuck at 45 lakhs. So in my opinion, and the recommendation that we have been making, is that at least for tier 1 cities, the definition should be increased to at least 85 lakhs to 90 lakhs. So that would bring a lot of inventory under the fold of affordable housing, and would classify for 1% GST and other SOPs that this sector would get. The second part of the question that you asked is whether the margins are thin. Yes. Affordable housing operates on a wafer-thin margin, and that's where I say that the ability to absorb shock is also limited, and coupled with a very wafer-thin margin makes this product very unviable for developer in today's scenario, where your construction cost has gone up by 10-15%, land prices have shot up, and there is highly uncertain environment that they are operating in. Your approval takes almost 2 years to 2.5 years, depending on what kind of land parcel you're considering. So overall, if you think of these variables, in today's scenario, even if the developer wants to come up with affordable housing, he is constrained by a lot of structural challenges that he's facing.
Got it. So there are structural issues. Of course, the definition needs to see a change considering the issues that we're seeing right now, and wafer-thin margins for developers, that's not working for them. Kartik, from a lender's perspective, do you think it's profitable to lend to the affordable housing segment? How does it differ versus the developer's POV?
It's an extremely, a profitable business and a very attractive proposition from a lender's point of view. Typically, the yields in an affordable housing business is about 300-400 basis points higher than the prime segment. The only difference is that the cost which comes with it is also higher, and affordable housing entities make a fairly decent. I mean, their industry level ROAs are about 2.83%, while the conventional housing finance companies will operate at about 1.8 to 2% ROA. So it's an extremely profitable business to work with. Credit cost is something that we have not seen a full cycle, because that's the segment has grown so fast that the seasoning in this business has been low. They have tried to keep the credit cost very close to the prime segment. So that's something that we will watch out very closely, because this segment has not seen too much of cycles like a prime segment. But otherwise, it's a very, very profitable business from a lender's point of view, and that's why we see a lot of housing finance companies getting into this segment. It's a different segment to operate with vis-a-vis their conventional prime positions. So they try to operate it via a separate business unit within the larger scheme of things. So it is a profitable business, but it requires a certain set of skills and also branch infrastructure and people infrastructure, which could be different and higher than a conventional housing finance.
Mm-hmm. Okay. Point taken there. Karthik as well as Prashant, thank you so much for joining us on the show this afternoon, helping us understand affordable housing. Where is that moving? Given the fall that we've seen over the years, what's happening there is important to understand. Thanks so much for that. A quick look in terms of what the market is doing right now, right? When you look at it, 24,120 around that mark, slight bit off the day's highest point, but yes, That's what we'll watch out for. Whether we manage to sustain this 0.5% of gain that we're seeing on the Nifty will be key to watch out for. IT is leading the charge today as well. And on that note, we're going to slip into a very short break. After the break, we'll have Dharmesha of ICRA Securities who will join us to discuss some of his trading strategies as well as individual stocks. Stay tuned in.